we're going to talk about secondaries. It's been this rapidly growing segment of in the financial markets. CapLight's been tracking it. They're a bit like a Bloomberg for the secondaries data. So they've got a Q2 report to kick us off, and over to you, Sid.
Thank you, Mark, and morning, everybody. I'm Sid. I oversee our markets team here at CapLight. By way of background, before this, I was doing equity research for large cap banks at Goldman Sachs. For those of you that don't know CapLight, we are two things. We are a data provider and a market intelligence layer for venture capital investors, and we're a liquidity venue where institutionals transact in these pre-IPO venture-backed companies. Think SpaceX, OpenAI, Anthropic, Stripe, etc. Over the next few minutes, I'm going to go over what the venture secondary market is, why you should care about it, and what we're seeing in it moving forward. So quickly to define secondaries in the way that I'm going to be talking about it here is pre-IPO venture-backed securities. So again, the companies that we all know and talk about that transfer shares outside of primary fundraising efforts, right? So that's investors looking for liquidity, other investors looking to get access to these companies before they go public, or employees.
People mute yourself if you've got anybody in your background. Sorry, carry on, Sid. Sorry.
Or employees looking for liquidity. And this is a rapidly growing market. It has 5x in the last 10 years. It does over $100 billion in annual volume. And there are structural changes that lead us to believe that this trend is going to continue. For one, there are more private companies than public companies in the US right now. And these private VC-backed companies are staying private for longer than ever. This creates two tensions. One, existing investors and employees are looking to cash in some of their gains on their paper gains that they've locked in on money over the years, and essentially maybe return that back to investors or invest it in other opportunities. And investors want access to these companies before they go public, because as we will go over in this presentation, a lot of the value accrual now happens while these companies are private and before they go public. So why should you care about this market? It's because over the last 12 months, VC secondaries have returned more capital to investors than IPOs. And if you are a venture capital investor not using the secondary market, we believe that you're behind. And we're kind of seeing an adoption by the institutions into this market. Fund-driven volume, that is venture funds, other investment funds, buying and transacting into this market has 10x'd over the last 3 years alone. And we're seeing over $1 billion of volume in 2025 with this. So you have an institutional market that is rapidly growing and concentrated in the hottest companies that are coming up. And the reason why we're well equipped to tell you about this is because as CapLight, we sit on hundreds of billions of dollars of proprietary secondary markets data that is sourced from a consortium of over 300 broker-dealers that give us their closed trade transactions, bids, offers, etc., that helps us bring transparency to this market that is generally seemed to be kind of illiquid and opaque. And what transparency does then is bring more transactions and more institutions into the market, which is why we work with every major asset manager, bank, and fund in the world that are now entering the venture secondary space. One of the biggest tailwinds about private tech and these private companies seeing so much investor demand is that not only have they usually been insulated from turmoil in the public markets, but also outperformance when the markets are doing well. Over the last 1 year, the NASDAQ 100 has returned about 35%, whereas a weighted index of the top 20 private companies has returned about 5x that. And the caveat to that is that these names remain heavily concentrated in the top 15 issuers, right? So these are your SpaceX, which recently went public, Stripe, Anthropic, Crusoe, Grok, which was recently acquired by NVIDIA, Lambda, Databricks. These are frontier companies concentrated in AI infrastructure, in defense, in physical AI, robotics, in fintech, prediction markets, that for now, for the foreseeable future, the only way to get access to is through the venture secondary market. And we believe that's not changing anytime soon because the bar to go public has never been higher. On the face of it, 2026 has been a record IPO year. But if you look closely, 65% of volume that came in the first half of 2026 came from SpaceX alone. Outside of that, the most likely IPOs of 2026 that are up to come, such as OpenAI and Anthropic, the other AI giants that have already confidentially filed for IPOs, they generate billions in revenue, compete in the largest TAMs in history. If anyone's seen SpaceX S1 before it went public, a $28 trillion TAM for a company that was IPOing at $2 trillion valuation in the largest IPO in history. And most of these names need no introduction. Everybody here knows ChatGPT, everybody here knows Claude. So, and even then, OpenAI is rumored to push their IPO into 2027. So if you're an investor and you want access to the venture secondary market, you want access to these fastest growing companies, for now, the venture secondary market is the only avenue. And we believe that trend will continue. In a concentrated market where it is likely that three of the largest players might go public, one of the biggest questions we get asked is what happens when these three go public and who fills the gap there? And being in our seat, we essentially see the youngest and fastest growing companies. And since 2025, over 103 new companies have transacted for the first time in the venture secondary market. And about 100 others roughly have received their first bids and are waiting to close a transaction. What this tells you is that the secondary market is evolving from going from investors that were chasing the fastest growing, highest known names into now trying to find the next Anthropic, the next OpenAI, and the next SpaceX, and investing at a much earlier and younger stage within the companies and go along with the ride as these companies stay private for longer than ever and maybe eventually go public. So to tie it all back together, we're in one of the fastest growing large market in the venture secondary market that is concentrated in the most important companies in the world that everybody wants access to. And as CapLight, we bring the data to bring transparency to this market and also a venue to transact in it. So thanks very much for your time, and I'm happy to answer any questions that might come up.
Great, thank you, Sid. I also think it might be interesting, although I'm sure there'll be questions, but you have just a little bit on CapLight. How deep is your database? You talked about those 15 names. How many names are you covering at the moment?
Yeah, so on CapLight as a tool of market intelligence for venture capitalists, we have over 55,000 companies. That include secondary transaction data, funding round data, firmographic information. We have in-profile information on over 35,000 investors that transact in this space. And where our proprietary data kicks in is we have over 300 broker-dealers that give us their transaction data, closed offers, and bids. So that's led us to having over $300 billion in proprietary transaction data that we have on these companies, over $10 billion in closed trades, and a lot of liquidity. So we see over about roughly $5 billion in active buy or sell orders in these names on any given day across the platform.
Excellent. Well, we're glad to be partnering with you, and we'll see more of you. So we've assembled a panel to interact on these points, and I'll just throw on the screen some of them. I know that Dennis Blank from London Technology Club is not able to make it, but I think someone from LTC is able to make it. Jeff, okay, yeah. You're an interesting player, and I've known some of your principals for a while now. And what I love about London Technology Club, you're like a soul brother, soul sister of 361 Firm. You gather both in London, but in addition to London and Hong Kong and Dubai, and you have an investment arm, which you're part of, LTC Invest. and you've been accessing employee shares at a discount. You have a certain formula. I believe it's like 1 to 5 billion. And you've got a good track record. So all things we like. But I'm curious how you guys see the secondaries market, what scares and excites you today. I'm going to go around to all the panelists and ask that same question.
Sure thing, sure thing. And thanks again for the invite, Mark. So I think what excites me the most today is that this is one of the last genuinely very inefficient corners of a very large asset class today. Like across public markets and PE secondaries, price discovery is very crowded, is tight, the spreads are a lot thinner. In late stage VC, and in the top 20 names, perhaps you are seeing a similar outcome there. But outside of those top 20 names, the pricing is still quite opaque for most buyers and sellers. It is typically bilateral and very relationship driven, which means that information and access, and it's not just is really what's setting the price, not necessarily just having access to the capital itself. So for us, this is actually what brought Dennis into the firm. This kind of structural setup is extremely rare. And there are essentially trillions of dollars of NAV essentially trapped in the ecosystem due to this lack of liquidity, which is why you've seen this large increase in secondaries volume, and that has also increased a lot of tourist money entering the ecosystem as well. And none of these individuals ever really plan to hold for 13 plus years, and there's not really a dedicated buy side for this. You are seeing a lot of late stage funds and crossover funds and family offices move into this space, but they are typically going over the same 20, 30 names. But there's a long list of companies which are neglected. But that's what excites us, but it does scare us a lot. You're seeing multi-layer SPVs, fees on fees. You're seeing that was very common across Anthropic and SpaceX and OpenAI's. And there is a lot of adverse selection and fake discounts, which are sometimes in the market. And there's a uncomfortable question that we have to ask, and it's just why is this sometimes available and why is it available at this price? And sometimes it is just a fund out of life. Sometimes it is just you do not have the information at hand that the counterparty has. And when you are seeing these multi-layer SPVs, you're seeing people acting predatory in some aspects in the fact that they have access. So it was not uncommon to see 20% access fees for Anthropic at one point. And I think this is, if you're an unsophisticated player in the market, it is a genuinely, it is a scary place to be operating because fraud can happen. The fees can erode your returns. And there's a lot of SPV managers who have never really managed money in the past.
So maybe to that point, that's something, Sid, that CapLight does. You reflect what the fees are as much as you can. Do you remember yourself reflecting a 20% upfront fee?
No, totally. If you look at the top four names, right? So that's SpaceX, OpenAI, Anthropic, and Durrell. It was not uncommon to see most SPVs come with hedge fund mechanics for them, which was 2% management fee, 20% carry. And you're paying that just for access to these companies. These are not active funds going out and making sure you hedge the right way year over year. These are companies or SPV managers that have access to the companies. And to get access to these companies, you pay the 2 and 20 mechanics. A great litmus test for this is going to be once the SpaceX lockups start expiring and you start to see how these SPVs unwind that hold all of the SpaceX stock. And I think we're going to see a lot